Well, good evening, everyone, and welcome to this webinar focusing on residency for investment, hosted by Sanlam Private Wealth and Argosy. Really appreciate everyone taking the time to dial into this webinar. I think it's certainly a topic that's been hotly debated and written about in the local media and the press. We see it in social media on a daily occurrence. So maybe just firstly from Sanlam Private Wealth side, the question is maybe why are we looking at this and why are we hosting this webinar? I think, firstly, we started getting a lot of requests from our clients around this residency scheme and just general, there are quite a number of different schemes out there for people to invest in, either for residency or citizenship, different jurisdictions, all with different requirements. And I think the more research you do into the space, the more you realize there's a lot of misinformation in the market and things that I think really difficult to understand. Once you get into the process, we've had a number of clients that contact us, they've started a process, and once they're in it, they realize that they didn't really understand all the requirements, to go through the process. So I think a large part of tonight is going to be focusing on giving clients a full understanding of this. We're going to talk a bit more around Portugal and why we see Portugal as one of the better jurisdictions, especially for clients that are looking for an option B. We're specifically talking here with people, we've got a lot of South Africans looking for option B. They want to live in South Africa, but they want some form of insurance policy into the future. So that's what we'll be going through tonight. And then I think quite important with webinars is I think we've all become quite accustomed to. Please post questions. I think there'll be a lot of questions coming through tonight. Post them in the chat box. So we will certainly from our side and the team from Argosy, and we've got Thomas from CCA in Portugal on the line as well. We'll try and get through as many of these questions as we can. Any of the questions we don't get to, we will certainly put them in written format to all the participants so that everyone's got a full understanding of the questions and answers to the questions at least. So I think maybe just before I hand over to the team that's going to be doing all the presenting, from Sanlam Private Wealth side, as I said earlier, when we started looking into this, we first and foremost had to nail down a jurisdiction and make a call on that side of things. So the team will touch on that, but I think more importantly is partnering with the right people on the other side. And who you'll hear from tonight is a team from Argosy. They'll introduce themselves in a minute because there's quite a bit of expertise sitting on the other side of the call here out of Isle of Man. So the reason we partnered with them from a Sanlam Private Wealth side, so Argosy and their local counterparts, Mergon, we've got a long-standing relationship with the teams. They've got extreme expertise in the property sector. They'll touch on that in a second. So we've got a lot of faith in them as a management team. And I think that's quite an important starting base with anyone that you work in a new jurisdiction, is that you've got a trusted relationship with them. And that's certainly something that gives us comfort. So I think hopefully, as we go through this, you'll get some comfort from the team that's sitting on the other side. And I think quite importantly as a way forward, as we go through this, you're going to see there a lot of things for anyone that's taking this seriously and want to consider this. There are quite a couple of changes, or one big change coming into this year where the investment amount in Portugal is changing from 350,000 euros to 500,000 euros. So for people still looking to make that cutoff before end of the year, there's a lot that we need to get done before end of the year. So we'll go through those hurdles and we'll give you a lot of information on what needs to be done during these next couple of months. So for those that want to get into contact with us, if you're an SPW client, please get hold of your portfolio manager. Otherwise, we've dropped an email on the chat box there. So if there's an info@privatewealth.sanlam.co.za. So please get in touch after this webinar and we'll put you in contact with all the right expertise and experts on the other side to help with the process. But I think with that as background, Malcolm, Pierre, Nick, I'm going to hand over to you guys, start the presentation then, and we look forward to this. Thank you. And thanks again for
Thank you, Reggie, for that kind introduction. And good afternoon to everyone. As Reggie mentioned, my name is Pierre Goosen, and with my colleagues, we want to thank you for giving us this opportunity this afternoon to present to you the opportunity to invest in Argosy Property Ventures Fund 1. So to make best use of our time this afternoon, what I think I'll do is just give a short introduction on Argosy and the people around the table. And then we'll spend about 30 minutes to talk through a presentation where I will focus more on the fund side of the offering, and Malcolm will focus on the investment strategy and structure of the fund. Very importantly, also we'll finish with where Malcolm will talk us through the action points, immediate action points and timelines, should you be interested in taking up the offer or opportunity to invest in the fund. Hopefully this should give us enough time to deal with any questions you may have at the end of the presentation, but as Reggie said, we will definitely make ourselves available after as well to answer any further questions you may have. And if you have not received a copy of the presentation yet, please use the link that's in the chat room and we to make contact, and we'll make sure you receive a copy of the presentation. Okay, so thank you. Starting with Argosy. Argosy is a privately owned private equity firm based here in the Isle of Man. Argosy was established in 2008 with the support of the Mergon Group, which is based there in Stellenbosch in South Africa. Some of you on this call may be familiar with the Mergon Group, but for those who are not, Mergon origins goes back to the 1980s, and amongst other things, Mergon was one of the founding shareholders of the Atterbury Property Development Group, Atterbury being one of the largest and most successful property developers in South Africa. It also played a significant role in the early years of ATTAC, which is a listed REIT on the JSE, and more recently with the establishment and one of the founding shareholders of King Price Insurance, which is one of the fastest growing insurtech companies based in South Africa, and Mergon is a majority shareholder in King Price. So over the past 13 years, with the support of Mergon, Argosy has founded and has been instrumental in the growth of several businesses outside of South Africa, and most notably in real estate. You'll see there on the presentation, Argosy was one of the founding shareholders of Artisan Real Estate Advisors, which is a UK-focused property developer. And Artisan has had many award-winning schemes that are developed across the UK, one of which is the iconic £200 million development in New Waverley, which is in the heart of the old city in Edinburgh, Scotland. Argosy was also one of the founding shareholders of Mass REI, which is a CEE-focused real estate fund listed on the JSE with assets close to €1.5 billion. So Argosy has now over more than a decade developed a strong team with a real offshore presence, with a real track record and extensive network across the UK and Europe. For more information on Argosy, please visit our website where there's a lot more information on our investments and our strategy, should you wish to know a bit more about the company and the group. So in the presentation, we give more information about the team, and we will touch again a bit on this later, but just if you allow me to make a quick introduction, and Reggie has already mentioned some of this, but on my left is Malcolm Levy. Malcolm joined Argosy in the end of 2019, just before the onset of the COVID pandemic. But although new to the Argosy team, we have been working together now for many years, with Malcolm also being one of the founders of Artisan and Mass, where he served as Executive Director from 2009 to 2019. On my right is Nick Dashfield. Nick joined us last year from London, where he worked at a large international firm as a senior associate, and we're very happy to have Nick as part of our team as well. And then finally, sitting there in Lisbon, Portugal, is Thomas Texteira of CCA Law. So Thomas has been involved in advising clients through the whole process of making the investment, applying for your residency visa, and ultimately through the process of applying and receiving your full citizenship in Portugal. So we thought it's very useful to have Thomas on the call to try and answer any regulatory or legal questions that you may have. So Thomas, thank you also for joining us this afternoon. Okay, so turning to the presentation and the opportunity itself. Similar to Reggie mentioned, we started looking at these different schemes after being asked by our colleagues in our network in South Africa to comment on all these golden visa schemes that are available. And as we started looking at and through all these interactions, we realized that there's a real and clear demand and need for this type of product. And although there are a number of providers, there's a clear preference to align with a known and trusted partner. So to put very simply, what does Argosy Property Ventures Fund 1 offer? Well, for an investment of 350,000 euros or 500,000 euros, and we'll explain the reason for the difference a bit later in the presentation, an investor will get the opportunity to benefit from Portugal's residency for investment scheme, while at the same time earning an attractive return on investment. So why Portugal? So Portugal is more than just good wine and food and weather and beautiful beaches and old cities. Portugal consistently achieves one of the high ratings across quality of life indices. Its cost of living is one of the lowest and most affordable across Europe, and has been declared one of the top 10 best countries to retire due to its affordable cost of living and excellent healthcare services. Portugal also has 300 days of sun per year, which if you've lived in the UK for the last 14 years, that is a stat that stands out to you. Portugal is also ranked as the first safest country in the world to live. It's got a very robust economy with above average GDP growth, forecast to be 6.5% in the current year and 5% next year. And it's got a very favorable tax regime. Its healthcare is also highly rated. It ranks 13th on the Euro Health Consumer Index, which is better than the UK, as an example. And it's funded through the Public Healthcare Service, the National Health Services, and is accessible to all residents in Portugal. It also has a very strong education system, with state education being free, and it has a large network of fee-charging private and international schools. I think it's also worth pointing out at the top there that once you receive your citizenship in Portugal, you will have full and unrestricted access to the European Union. So from a jurisdiction and country perspective, Portugal ticked the box for us. So starting to look at the scheme itself and how it compares to other schemes that might be offered by other European countries, also other jurisdictions. I think this is a very important slide to just stop and explain the difference here as well. Portugal offers a residency for investment scheme versus not a citizenship for investment scheme. This is an important distinction. You might find some jurisdictions still offer the citizenship for investment scheme, like Barbados and Bermuda, but it's questionable how attractive long-term residency are in these jurisdictions. Within the EU, these type of schemes have been discontinued, with Cyprus and Malta being the last that fell away. So the more traditional, recognized, and less aggressive way of getting citizenship in a country is through residency, spending time in a country for a period of time, after which you can apply for your citizenship. This is the same process I went through, where I had to live in the UK with the Isle of Man for 5 years, after which I could apply for my citizenship, UK citizenship. This program provides the individual with that residency requirement in order to apply in the end of the period for your full citizenship under the Portuguese nationality rules. So this meets the EU rules, and we feel this makes this scheme much more robust than maybe others and sustainable than others that you may see. Then comparing the scheme with some of the other European countries, we feel it's amongst the most flexible in the EU for the reasons listed here. It's a qualifying investment fund. We believe is much more flexible than some of the other options, and we will touch again on that a bit later. The minimum threshold, investment threshold, there you'll see is 350,000 euros for applications done before 31 December and 500,000 euros for applications done after 31 December. And again, this is an important point, and so we'll come back to that later. It's also very flexible in the amount of time that one needs to spend in the country and able to apply for the citizenship. If you compare with Ireland, Greece, Spain, and Malta on this slide there, you will see that in the first week, our first year, you need to spend 1 week in the country and then 14 days in each subsequent year. After this 5-year period in that you've had this residency visa, you will be able to apply for your citizenship after passing a basic Portuguese language test. During this period in which you have the residency visa, you and your family and dependents will have the ability to live, work, and study in Portugal, and you will also have free visa travel in the Schengen area. Within Portugal, there are a number of ways to make a qualifying investment, and these are listed on the slide here, some of which requires direct investment into property or a significant amount being deposited in a bank account in Portugal. We believe the qualifying investment fund provides the best option for investors. The reason being that it saves you the hassle of having to find, acquire, and manage direct property. It gives you the benefit of diversification within a fund, within a portfolio, and the fund rules that sit around these qualifying investment funds are very flexible, and Malcolm will talk us through that again also a bit later in the presentation. Now, I think it's important to point out at this stage that there are significant changes being introduced to the Portuguese investment program at the end of this year. Although all benefits of the investment for scheme remains exactly the same, the minimum investment amount will increase from 350,000 euros for applications received and processed prior to 31 December to 500,000 euros for applications received after 31 December. Now, we remain confident that applications can still be lodged and processed prior to 31 December, but it is worth pointing out that there are a number of regulatory and also administrative hurdles that will have to be crossed in order to meet this timeline and benefit from the lower investment amount. Unfortunately, some of these steps don't sit within our or the investor's control, and we are a bit reliant on some regulatory and government bodies and also on compliance departments within, for example, banks to complete the process. However, we have advisors both in Portugal and in South Africa that can hopefully help, will be able to help with the process. And if certain immediate steps are followed, we still remain confident, as I said earlier, that the cutoff date can be achieved for the lower investment amount. However, if for some reason the deadline is not met, this opportunity will remain open for investors until March at the higher investment amount of €500,000. Clearly, this is an important point, and Malcolm will talk us through all the different steps and timelines, immediate steps and timelines that have to be taken in order to benefit from the €350,000 investment. So in summary, on the visa side, I think let's look at the timeline and see what this all means. So we will take an investment or commitments from October this year to March next year. After investment is made, applicants will have to make application for your temporary residency visa in Portugal. As mentioned, if these applications are processed before 31 December, the investment amount is €350,000. After 31 December, it's the higher amount. Once application is processed, the applicants need to then have an in-person in Portugal biometric that needs to be completed, and for that appointment needs to be made. At the moment, there is a delay in making these appointments of 6 to 9 months, but we hope that as the COVID-induced backlog is cleared, that that process can be expedited and be quicker. Once biometric is completed, you will then receive your residency card, and it's from this point that you will be the benefits of the residency investment program, and the 5-year clock starts to run. At the end of that period, as mentioned, you will then be able to apply for your full citizenship, and the fund will remain open across this entire period to allow people to benefit from the program and also go through the citizenship application process. So exits will then be managed from 2028 to 2009, and also the redemption of investments. So hopefully that gives a bit of background information quite on the visa side. And Malcolm will now talk us through the fund, the investment strategy and structure on the investment side. Thank you, Malcolm.
Thank you, Pierre. So we've heard about the visa side of the opportunity. I'm now going to touch on the investment side. The fund will raise a minimum of 20 million euros, and this is how we intend to deploy that money. Firstly, 60 to 70% of the capital raised will be deployed within Portugal in commercial property, and 30 to 40%, up to a maximum of 40%, will be deployed in the UK in residential property development. Looking first at the dynamics of the property market in Portugal, in particular the commercial property market, the Portuguese commercial property market dynamics are very similar to what they are across the rest of Europe. Standing investment properties are acquired at yields between 6 and 8%. There is the opportunity to inject some moderate gearing at between 30 and 50% on those assets at an all-in cost of between 2 and 3%. And that gives us a geared yield of 10% or a little bit above 10%, from which we deduct management fees, operating costs, and tax. And that gives a net return on investment in commercial property of 7 to 8%, plus the capital growth that you are able to achieve on those assets through asset management and active asset management over the holding period. Within the UK residential market, the dynamics are relatively well known and well understood. There's been a long-term structural shortage of residential housing developed in the UK for a long period of time. This has resulted in high prices and a shortage of supply, which means that developers are able to earn attractive yields on development properties in the UK, and development margins are typically north of 20%. We feel that this gives an attractive mix of the majority of the portfolio invested in income-yielding commercial properties in Portugal, with asset management opportunities to grow that income further, and provides us a kicker in the return with exposure to UK residential opportunities, which is a market that we know well. Our view is that the residential market in Portugal is a little bit overheated at this time. Some of the changes to the residency scheme that Pierre has been telling us about are aimed at trying to address that. Locals are getting priced out of the market, in particular in Lisbon and Porto, and to an extent in the Algarve. And as a result, if you invest directly into a property in order to apply for this visa scheme, you will, from 2022, no longer be able to acquire property in those key locations in Portugal. This mix is, in our view, a key differentiator from our peers. There are several other fund opportunities available to investors. The majority of those alternative opportunities are focused on residential property. Okay, let's take a look at Portugal. What we have here is a population density map. Portugal is a country of approximately 10 million people, and you can see on the map that they are centered around Porto in the north, and in the middle to southern area around Lisbon. Economically, Portugal has something of a checkered history, which came to a head in between 2010 and 2014 with the financial crisis in Portugal. And Portugal wasn't the only one. The peripheral countries in Europe had a financial crisis. However, a lot of steps have been taken by the European Union in order to address that. And the European Union has come out stronger through that process. And this has immensely benefited those countries such as Portugal. And as a result of this, Portugal is expected to be one of the fastest growing countries, and the forecasts on all of the standard forecast models show Portugal to be one of the fastest growing economies in Europe coming out of the pandemic. Taking a look at the opportunities of interest, there are various sectors that we like in the Portuguese commercial market. There are also some sectors that we are more cautious on. Retail is a sector that we generally like. However, high street retail is challenging. There are areas of high street retail that we think will do well, but those are centered around dominant shopping centers and retail centers across Portugal. Given the size of the fund that we are raising, we are not going to be able to compete with those dominant centers. And so we aim to avoid high street retail altogether. Secondary retail assets are having a significant threat and are struggling in the light of e-commerce and more people buying goods on Amazon. However, one part of the retail market that we are attracted by is food retail. Food retail has typically very strong covenants. We've got on the slide here some of the main food retail operators in Portugal who are all very, very strong covenants with long leases. And this is particularly attractive for a product such as the one that we are putting together here. As you can see on the map, we have got a portfolio of 6 retail units that we have, food retail units that we've been looking at. These are available at a yield of approximately 6%. These are in strong locations, again with excellent covenants, and would fit very well within our strategy for this fund. We also like the logistics sector. This is a sector that generally, not only in Portugal, but across Europe and globally, has benefited immensely from the pandemic, as the move to e-commerce has accelerated and more parcels have needed to be delivered. We have been looking here at 2 units. These units are on the outskirts of Lisbon, and whilst we have limited capital to deploy and we have to be very selective on what we acquire, and we are mindful that logistics assets are quite expensive, the dynamics where there are asset management opportunities are particularly attractive to us, and so we are looking at those logistics assets. Skipping forward a few slides to the UK. I've already touched on some of the dynamics of the UK residential market, which we unpack in a little bit more detail here, which is long-term structural undersupply, which leading to these very healthy development margins that we see in the market. However, we are looking to operate a little bit below the house builders. The large house builders typically do estate-type developments in the UK. We will be looking at developments of between 5 and 25 units in the market. We have been looking at one particular opportunity in Farnham, in Surrey, which is in the southeast of England. This was an opportunity to develop 9 units. The example of how that model works is you acquire the land. There would have been an acquisition of approximately £2 million. The development would have cost £4 million to develop 9 residential units, and then the gross development value is approximately £8 million, giving you a development profit of £2 million on £6 million total development cost. The UK residential market is a market that we have a lot of experience in, particularly through Artisan. Artisan is a UK developer and is now predominantly a house builder within the UK. They operate in a slightly larger part of the market to where we will be looking to operate. Equally, within Portugal, we have a lot of experience through Mass Real Estate. Mass has built up a portfolio across Western Europe and more recently been exiting Western Europe to move to Central and Eastern Europe, where it has built up a large portfolio of commercial properties across those jurisdictions. Moving forward to the people. So that is the opportunity. Now, who's going to deliver this? We've already heard about Pierre and myself and Nick. But in addition to that, we have also been able to secure the services of an individual with over 30 years experience in these markets, investing across Europe. I think it's unusual to be able to access an individual with this much experience, and they will be joining us from the beginning of 2022 and will be immensely helpful both in Portugal as well as with the developments in the UK. In addition to that, we also have two advisors that many of you may be familiar with. The first is Dieval Joubert. Dieval Joubert was a founding partner of Prime Capital in Romania, and Peter Forer is a CEO, is the CEO of Mogon, from which we've heard a lot from Pierre. Okay, I think now we need to look at the structure. So that's how the money will be deployed. It will be deployed up to 60%, a minimum of 60% in Portugal and 40% in residential in the UK. What does this look like from a structure point of view? Investors will invest into APV Fund 1 and will receive their units in the fund. The fund will be managed by a regulated fund manager in Portugal. That regulated fund manager will be Fundbox. Argosy will act as the advisor to Fundbox with respect to the acquisitions that the fund will make. The depository bank that also adds a layer of protection and regulation within the market is Bison Bank, and they will act as the depository. I've spoken about the commercial investments, but I do want to unpack in a little more detail the structure around the developer. With regards to development, if we raise 20 million euros, 12 million euros will go to commercial property and 8 million euros will go to development property in the UK. Argosy will invest 2 million euros of equity into the developer. That will be first ranking loss equity in the developer, in addition to the 8 million euros from APV Fund 1, giving a total of 10 million euros in the developer. The APV Fund 1 will earn on their 8 million investment, they will earn a 5% return on preference shares. So they will invest through preference share equity with a 5% coupon. And so APV Fund 1 will earn a 5% coupon plus 50% of the development profit that is earned by the developer. We have thought long and hard about the best structure that optimizes the risk and reward for the fund, given the profile of investor into APV Fund 1. And we think that this is the best blend between risk-taking development. Development is a riskier part of property investment to investment in commercial assets. And we think this gives the opportune, the ideal, the optimized return for investors in APV Fund 1. Okay, so what are the key terms? The fund will be a 7-year fund. We're looking to raise a minimum of 20 million euros. The minimum investment is 350,000 euros. With regards to the fees, there is a upfront 1% of commitments establishment fee, and there will then be an annual management fee of 1.75% of total commitments. There is no performance fee on this fund, and I want to emphasize that is also a differentiator from some of our peers who would typically have a performance fee at the fund level. Our expected return is an 8 to 10% IRR. That is a euro denominated IRR. Of course, if you're investing from South Africa, there would be some expected rand depreciation over that time. So your rand-based IRR would be expected to be a bit higher than that. And from a co-investment point of view, the Argosy partners, namely Pierre and myself, will be investing personally into this with our own money and going through the visa process alongside all of the other investors. In addition, Argosy, as developer, will be capitalizing the UK development SPV with 2 million euros, as I discussed on the previous slide. Okay, moving on to the fees. What you get by going through this process and ultimately applying for citizenship with Portugal is access to becoming a European Union citizen. That is extremely valuable, but that also comes with some costs that you need to be aware of, and these costs are not immaterial, and we outline what these costs are on this page. These costs are in addition to the 350 or 500,000 euro investment that you need to make. And so we would highlight those to you so that you can take note of those. Those are not all paid up front. Those are staggered over the period of the visa. But we are trying to be as absolutely transparent as we can with regard to those fees. Not all of the competitor funds out there will be as transparent, and there are some people that have got into the process not aware of what the entire cost might be. Okay, that's the costs and the investments and what we're going to do. However, we are now in the middle towards the end of October, and time is getting tight. There are a lot of steps that need to be undertaken in order to get investors over the hurdle by the 31st of December, if that deadline is important to you. And so what we've done is we have laid out a relatively detailed note that outlines step by step everything that investors in South Africa will need to do in order to get through the 31st of December deadline for the 350,000. I would like to take us through that. It is outlined here. These are the steps here, but I'm going to go through each of the steps in a little bit of detail because I think a lot of the questions will be focused on this. First and foremost is you need to appoint a legal advisor in Portugal. We have, and Thomas is on the line from CCA. We recommend that CCA are appointed as the legal advisor. This is urgent. The contact details are here. Once you get in touch with Anash, she will set up very quickly an introductory call with you and will request the following information from you in order to be able to take you on as a client. It's important that this is done quickly because you need to move relatively quickly from step 1 to step 2, which is the application of a Portuguese tax number. All investors in the visa program will require a Portuguese tax number. And in order for CCA to apply for that tax number on your behalf, you will be required to give them a power of attorney. That power of attorney will need to be apostilled. Again, we have facilitators lined up to assist you with that process of getting that power of attorney apostilled and returned to CCA so that they can apply for your tax number in Portugal. Once you have, or not once you've done that, simultaneously with that, the first 4 steps in the timeline are things that you, if you are interested in taking up this opportunity, we recommend that steps 1 to 4 are undertaken immediately. Step 3 is obtaining the South African police clearance certificate. This can take a little bit of time. There are 2 ways of obtaining the police clearance in South Africa. There is the normal way that can take 10 to 12 weeks and is going to be unhelpful. There is then also the urgent basis approach to getting it. It's very important that you take the urgent basis approach. That police clearance will also need to be apostilled. And we have lined up Audrey Ferrie at Docnetics to assist with the process. She will be able to advise you with where you should go to obtain your police clearance and all of the steps that you need to take in order to get that document apostilled. Simultaneous with all of this, you're also going to need to obtain a SARS tax clearance. This is relatively more straightforward and can either be done online or with the assistance of a tax advisor. Once you have your tax number, your Portuguese tax number, you can begin the process of opening a Portuguese bank account. We are in the process of lining up and have several banks lined up at which you will be able to open a bank account in Portugal. This can also be a lengthy process, particularly with regards to KYC, and hence it's important that all of this KYC is obtained upfront and that process is commenced as soon as possible. Once you have a Portuguese bank account, you will then be able to deposit your funds, your 350 or your 500,000 euros into that bank account in Portugal. What is important when you send that money is that ultimately when you submit the application to the SCF, it is important that the bank can trace that that money came from a bank account in your own name. In other words, it is you that is depositing the money into the bank account in Portugal and that is then making the investment. So it's important that when you make that transfer, you keep all transfer records and SWIFT details to be able to prove that it's come from a bank account of yours offshore or from yourself into your bank account in Portugal. Once the monies are in your bank account in Portugal, the monies will then be invested into APV Fund 1. This is a relatively administrative process, but there is another element of KYC where Fundbox will again be required to do investor due diligence on all investors coming on into the fund, and that KYC is going to be similar to the KYC that is used further up for the bank account opening. Lastly, once the investment has been made into the fund and you have received your unit, CCA will then be in a position to submit your application for residency with the SCF. What is important is that the principal applicant has done all of their documentation, which is outlined here, including the apostilled criminal record, evidence of the tax number, and evidence of the qualifying investment. In order for that application for the principal applicant to be lodged with the SCF, that needs to be done by the 31st of December if you are to benefit from the 350,000 euro cutoff or the amount. However, you are also able to, on that investment, that single investment of 350,000, that will also allow you to, your spouse and your minor children or dependent children or parents over the age of 65 that are dependent to also apply for a residency visa in Portugal. However, the documentation required for the spouse, minor children and other dependents is more extensive than it is for the principal applicant. And I want to emphasize that point. What is important is that the principal applicant gets their documentation in by the 31st of December. Other applicants can then piggyback, dependents, not anyone, dependents can piggyback upon that application after the 31st of December. If you are able to get all of the documentation together, that of course is the first prize, but I would emphasize that the documentation here is more extensive than the documentation required for the principal applicant. There is a lot to do. It is not guaranteed that applicants that start the process will be able to invest by the 31st of December, but we have done our very best to line up a suite of advisors in both Portugal and in South Africa to help. And we are confident that if investors are diligent in going through all of the steps that we outline and work together with us, we do believe that they will be able to make it. But it will be, there will be a lot to be done and the timelines will be tight. I think that brings the presentation part to a close. We do think it's an interesting market in which to get a residency visa. We think that the offering, the investment offering is compelling, and we will provide support to investors to make sure that any necessary documentation is obtained and that the deadlines are met where possible. I think we now open it up to the Q&A. I see there are a bunch of Q&A questions. Reggie, should we just dive straight into the Q&A?
Yeah, I'll see. There's quite a couple of things. I've answered one or two of them as you were presenting. Maybe start with a couple. We'll go through them kind of just in a particular order. There's one question. It's a bit more of a, I think, a macro question, just with probably the concerns of real estate in China with the Evergrande story. So I think probably just some concerns. How safe is your investment with Argosy, given the kind of more macro concerns with the things that happen around Evergrande?
Okay, I think that's from Roy. So my understanding of the issues at Evergrande, a lot of that relates to gearing and their inability to repay. I think that we will take, given the nature of the investment, we will only take very moderate gearing. So there's two parts of investments that we'll be making. There's the commercial property part in Portugal, and then there's the development part in the UK. Within the commercial investments in Portugal, we will not gear beyond 50%. on a loan to value basis. We will be looking for commercial properties that have strong tenants with long leases and some opportunity to grow earnings over time. That would be akin to commercial property investments across the rest of Europe, and there are various investment companies exposed to that. Evergrande, I think, is in the residential development. So within the UK, I think the secret to not going bust in residential development is not to overgear, is to be able to secure the property without too much planning risk, and not overgear. And in those scenarios, those issues at Evergrande shouldn't arise. And clearly, our whole risk appetite and approach is very different to a highly levered developer, such as what I think that's what we're seeing there.
Okay. Moving on. So any reason you mentioned, I think in the presentation, with some of those schemes closing, I think more the citizenship by investment. So maybe just comment on why these things are declining. I don't think they're in decline. It's probably just those ones being shut down. Maybe just give a reason why they're being shut down in Europe.
Yeah, so maybe, Thomas, maybe you can also comment on this, but you correctly, the ones that we shut down, they were the citizenship for investment scheme. And I mean, these things are highly political within Europe. You know, if you just pay money, you get your citizenship immediately. You know, I think that's why for us, this Portuguese scheme stands out against those, because you follow the normal route to citizenship, which is your residency for 5 years, after which you can apply in terms of the usual rules that comes with that. So we feel this one is more robust, but you know, Thomas, maybe you can also add to that.
Thank you, Pierre. No, it's exactly that. It should be noted that citizenship by investment programs effectively have suffered. It's not a decline, but they were basically blocked by the EU. But the Golden Visa, as is commonly called, is not a citizenship by investment program, is a residency by investment program. So what you are granted is a residency visa that gives you the right to apply for a Portuguese passport according to the general nationality law. So the general nationality law states that whenever you have, or whoever has a valid visa in Portugal for 5 years and complies with several other requirements, which are basically related with language and with a clean criminal record, is entitled to apply for Portuguese citizenship. So I would not say that these types of programs are in decline. Most importantly, as was shown on the presentation, there are several countries that have this residency by investment program with different features and different investment types, but there are several countries that have them and will continue to have them. And in my view, I think that the EU will not intervene in these types of matters, considering the fact that this is granting of visas is a matter of internal sovereignty of each country, and that would be too much. So I would say that every citizenship by investment program effectively in Cyprus and also in Malta, I believe, they were effectively shut down. But besides those, the programs have been running without any problems and without any EU interference.
Yeah, thanks for that, Thomas. Maybe Malcolm, so the next, I'm going to link two questions together here on it's specifically around this 40% in UK. The first question is just more probably a technical one. Obviously, will it still qualify, you know, for the golden visa with it's only 70% invested in Portugal, but obviously, as we said, more than, you know, obviously 60 in Portugal. But there's another one specifically that asks, and you can maybe answer both of these, that, you know, why would you invest 40% in residential development in UK and not just 100% in commercial in Portugal? So maybe if you're clear on those two questions, maybe deal with both of those.
Sure. I mean, the short answer is that yes, you will still qualify for the investment. The investment is 100% into Portugal. APV Fund 1 is a qualifying investment fund. And so 100% of your 350,000 euros is going into an investment in Portugal. And that is a qualifying fund. In order to be a qualifying fund, the criteria, the technical criteria indicate that that fund must invest at least 60% of its investment within Portugal, and up to 40% can be invested outside of Portugal. So yes, your 350,000 euro or 500,000 euro investment will qualify for that. With regards to the inclusion of the UK development angle, I think that is two reasons. One is to diversify the returns out of Portugal, but also two, I think it's to enhance the return slightly in a market in which we know and understand, but also that I think our discussions with investors has shown that there is an appetite to diversify out of commercial property in Portugal only, with an element in a somewhat uncorrelated investment with strong return potential in the UK, and that's leveraging our skill and knowledge. You know, these are the markets that we know. We do not know residential development in Portugal, and hence that's not something that we would look to undertake.
Thanks for that. So maybe these next two we can also deal with together. I mean, the first one I think is quite an important one. So maybe just a bit more information on Fundbox and Bison Bank. And then also I think a very critical question which we need to deal with is what happens if we don't raise the 20 million euros as targeted for this fund. So maybe just, I think those are important things to highlight.
Thomas, maybe on Fundbox and Bison.
Thomas, could you maybe touch on Fundbox and Bison, who are, you know, obviously regulated institutions in Portugal?
Yes, of course. One needs to bear in mind that a fund, when a fund is incorporated, you need to appoint a regulated management company to exercise the management powers over that fund. And that management company needs to be regulated and duly registered and in compliance with all the requirements of the Portuguese Securities Authority, which is called CMVM. This is the case of Fundbox. I will not elaborate very much on the pros and cons of Fundbox because it would not be my role to do that. But what I can say is that they are, as a lawyer and with some knowledge of the market, what I can say is that they are very well established within the Portuguese market, and the experience that I've had with them in the past has been very positive in terms of being very demanding with the way they manage the funds that they have. In what concerns Bison Bank, Bison Bank is an investment bank that bought a banking license from a Portuguese bank, which was called Banif. Bison is originally a bank from Hong Kong, but they operate here in Portugal under a normal banking license. As a lawyer, I've had several experiences with Bison, from having clients opening bank accounts with them and working with them, and the experience has been always very positive in the way that they work, in the approach that they have towards the clients, and in the proactivity that they have within the sometimes very complex and bureaucratic process of opening a bank account. So I would say that these would be the two main features of both institutions.
I think it's also maybe fair to add that we did speak to other fund managers as well and other banks as well. We've also gone to visit them, and you know, I think through our process we were happy to appoint these two regulated institutions.
With regards to the 20 million euros, we are in the process of gathering interest in the investment. And within the next week, we will be in a position to understand where that demand is. So I don't think it's very long before we are able to give a good indication as to whether we are likely to achieve the 20 million euros or not. We launched and started speaking to investors 2 weeks ago. We had another webinar last week from which we've been getting a lot of interest. And now we are speaking to a wider audience, and within the next 5 to 10 days, we will know very clearly where we are on a demand side with regards to the investment.
I think the next one's a short and easy answer. That are the returns that targeted, and I think to be clear, it's a targeted return of 8 to 10% IRR. You know, are those net of all the fees, taxes, costs, profit share, etc.? I think that's a short, easy answer.
Yes, those are net of all the fees, and that's what you should expect to return. over an investment cycle in those markets. If we happen to buy at the very top of the investment cycle, which I don't think we're at, and we happen to exit at the bottom, of course, that'll affect those returns over the period of time. But no, 8 to 10% is what you would expect to get as a blend of investing in commercial property in Europe and residential developments in the UK.
Great. I think, again, the next two we can probably deal with quite quickly. Just a reminder on the time, I think that'll be in the presentation that we'll send through to everyone, but just the amount of time you have to spend in the first 5 years in Portugal. And I think an important one, maybe this next one's probably more important, is the age restriction. And I think especially for people with kids that are studying, maybe just touch on one or two of the issues we picked up in the last webinar around that. I think you maybe deal with those two together as well.
Very well. So, in terms of age restriction, it should be noted that so for the main applicant and for his spouse, there is no age restriction whatsoever. The golden visa entails the possibility of the applicant applying for family reunion, which means that they will be able to attach family members to their application. This family reunion regime includes parents over 65, and there is no need to prove anything if parents are over 65, and also children. But it is very important to state that children need to remain dependent at all times. And when we are speaking of minors, that's something that's assumed. Children need to be studying, they need to be financially dependent. When children reach 18, which is the majority age in Portugal, we need to make sure that the children remain studying during the whole time of the visa, remain financially dependent from the parents, which will be, in this case, the main applicant during the whole time of the visa. And also, which is also always a funny thing to say, do not get married during the 5 years of duration of the visa, because marriage is automatic emancipation according to Portuguese rules. So that would take them out of the visa. And as Malcolm stated before, this visa is not a cheap visa. So the golden thing you pay on this visa is effectively the fees that you pay to the government. The card is not a golden one, is a pretty standard card. So one needs to be very, very clear and sure when including family members in the application that they will be able to meet the 5-year requirement under the applicable rules, as I said before. Reginald, the other one was, sorry?
Let me just double check in. I think
the other one was time spent in the 5 years.
So time spent in the 5 years. So the rule is very simple. You need to spend an average of 7 days a year in Portugal, but you can spend 14 days in a 2-year period. So this is a general rule, okay? I may add here a thing which I find important, and I always say to my clients, which is, if the objective of all of this application is effectively to apply for Portuguese citizenship, although the law does not state this in anywhere, we tend to advise our clients to go a bit beyond this minimum level of 7 days. I'm sorry. And why do I say this? Because what we know is that nowadays every nationality that is applying for this program is applying for it with the objective of applying for a Portuguese passport at the end. So what we will see in 5 or 6 years' time is a lot of applications moving forward. And what we try to tell our clients generally is that we need to have applications for citizenship with, between commas, better quality. So if you do more than the minimum, your eligibility will be higher, because giving nationality is always something that is sensible. The law is vague on purpose to allow some discretionarity to the entity that is deciding. So my advice to everyone that's listening to the webinar is, if citizenship is an objective, you must try to go a bit beyond the minimum requirements, and you must try to create during the 5 years effective ties with Portugal that can allow you to strengthen your application in the future. Again, nothing of this is written in the law, but what we are foreseeing with the amount of applications for citizenship growing a lot during these 5 years is that whoever has better applications will be most likely to get approved quicker. It's basically that.
I think this next one, thanks for that. This next one is probably just around again that, how feasible is it to apply and be accepted by 31st of December? I think that, that's something that was dealt with, but I think there's a number of external factors one has to consider. The source of wealth. If you think about it, a lot of people have trust, as an example, offshore. Now, if the funds come from a trust, which we picked up before, it makes it very difficult for a Portuguese bank to understand. They don't recognize trust that we've picked up before, and Thomas, you can maybe comment on that. So there are a number of hurdles, but I think again that's each each individual circumstances will be different, and
Yes.
That's why it's important to engage with the relevant people and understand each individual circumstances, and on the back of that one can assess and give a realistic expectation. But there are a number of hurdles that obviously in the way, and it will be a reasonable challenge. But that's why we're comfortable with the people that's been lined up behind this to try and expedite the process. So I think for anyone that's looking to do this before end of the year, you won't find a more streamlined process. But again, you guys can maybe add to my comments on that.
Reginald, yes, I can add, and I think that at this stage, and considering if you want to meet the requirement of the 31st, I think we need to be quite pragmatic and try to keep it as simple as we can. Opening bank accounts abroad is always complex. The process is fairly simple, but then there is compliance. And when things go to compliance, if we don't have a fairly simple process with the timeframes that we currently have, we may be mixed in a compliance nightmare, and it may drag along. And this is something that it's very hard for us as lawyers to control. So every factor that we can control to try and keep the application as simple as possible needs to try to be met. Going directly to your question, Reginald, obviously, as I said the other day, in Portugal, trusts are not recognized. They do not exist for us. Unfortunately, for us lawyers, it's not something that exists here in Portugal. And in that sense, it's not possible for anyone to transfer monies directly from a trust to a Portuguese bank account, because that effectively would raise a compliance nightmare here with the banks in Portugal. Bear in mind that anti-money laundering requirements need to be assessed by law by the banks and also by us lawyers on different levels, obviously. So banks are quite adamant in defending themselves. So whenever we have a process that is more complex with legal structures that are not or that are not recognized in Portugal, it may tend to complicate things. So my advice here, and although we are already exploring this with the banks, my advice here would be, if your case is you have a trust, the flow of money should be trust transfer the money to your bank account abroad, and then you transfer the monies from your bank account abroad directly into your bank account in Portugal. This will make the process much simpler, and the likelihood of having of this raising compliance issues is very, very low. Okay.
I think maybe just to add to that, Malcolm mentioned that we were talking through the timeline. I think my recommendation for us would be, even if you've not completely made up your mind on whether to proceed with this or not, is to, in any event, reach out to CCA, have the initial call, and they will then also access on that call what information is required. And so the sooner you start with at least that, I think it will just help that if you do decide to make the investment, you can make the timeline.
Oh, exactly.
Yeah, I think maybe there's quite a couple of questions coming through, and I'm just consider, obviously we've got quite a bit of time pressures here, so we're going to try and get through all of these. As I said, we might not get to all of them, and we'll send answers, but there are quite a couple of questions on the tax side of things. So if you're going and you're getting a tax number in Portugal, what are the tax consequences for a South African resident to be still a resident in South Africa? I think there's residency-based tax globally nowadays, so maybe just a comment on that one. And I think, again, I don't know if you're the right person to answer that. We can certainly get a view on that. And then also just around this one question around medical assurance in Portugal during residency, and a couple of things around the language test. So maybe just on those three things, quite a couple of questions around those.
Okay, so medical insurance in Portugal is not required if you are not living here. If you would be living here, you would require to seek an insurance here in Portugal, but only in that case. Okay, so if you are applying for the golden visa but continuing to live in South Africa, the insurance is not a requirement. It used to be, it's not anymore. Okay. Second thing, tax implications. Please note that when we ask for a taxpayer number to any investor for a golden visa, we ask it as a non-resident. Okay, so the fact that you have a taxpayer number has zero consequence in terms of taxes in Portugal. So you will not be paying any tax here, and this arises no consequence on a tax level. Also, you will never be considered a tax resident in Portugal unless you spend more than 6 months a year here, in which case you may be considered a tax resident in Portugal, but that would be the case with Portugal and with every single country in Europe. So that's pretty much it. But the fact that you have a Portuguese taxpayer number does not raise any tax liabilities or tax responsibilities here in Portugal. Reginald, the other one was, sorry, my memory is not what it used to be.
No problem. No, so there was just around the language.
The language.
Final one.
Okay, so the language. Language test for golden visa is not required, okay? So you can get the visa without any requirements for language tests. Language tests will be required at the end of the process if you apply for permanent residency, if you renew your golden visa again, or alternatively, if you choose to apply for Portuguese citizenship. The requirements will be the A2 level of Portuguese. It's a basic knowledge of the Portuguese language. And what I can tell you from experience is that we've had zero problems with clients from multiple nationalities being approved or being able to get this A2 level approval. It's important to say that there are institutions that are approved by the government that give courses to applicants that want to apply for the A2 level and that validate this application. So if you are imagining yourself sitting in a government classroom with teachers monitoring your test, that will not happen. You can do a course online, or you can do a course in an institution and be approved, and then just add that to your application. Okay, so I think that's.
It's also not something you have to wait to the end of the period. You can take the test also multiple times.
Exactly.
The 5-year period.
Most of my clients get very, they have the enthusiasm of the beginning. So they start with a lot of strength in the beginning, studying a lot. Then they start studying a little bit less. Then on the 3rd, 4th year, they pick it up again and do it. And generally, I had no failures with clients of mine in the A2 level of Portuguese.
Malcolm, maybe this one, on the technical side is for you. There's a specific question here on sourcing commercial deals, offering yields north of 5% is difficult for even leading Portuguese-based and experienced players in the current market. With your limited Portuguese experience, how are you achieving better pre-gearing?
Okay, that's a fair question. So firstly, let's just talk about the team. I mean, you're talking to us here. But there is another individual, and we are going to give full details of that person very shortly, long before anybody invests. And I think that will give people some comfort with regards to the experience in terms of deploying capital in those markets. Elsewhere, most specifically at Mass Real Estate, we built up a very substantial portfolio in excess of €1 billion, acquiring real estate, commercial real estate throughout Western Europe. We did spend quite a lot of time looking within Portugal and have a network of agents, vendors, families that own properties in those markets. And that's what we will look to leverage in order to acquire this portfolio. But I do want to emphasize we're not talking here very substantial amounts of money. We're talking 20 million is the level that we are aiming as a minimum, and hopefully it's a little bit above that, but it's certainly not going to be hundreds of millions of euros that are going to be deployed. And so we don't need many great assets to achieve our aspirations. In addition, you happen to mention the 5%. I think the point is generally is how to get good yields. I think it's quite easy to get assets at above a 5% yield. We've never acquired an asset at below a 5% yield, but I think the principle of the question was, how are you going to buy opportunities that are more attractive than the market yield? And I think that's through network, contacts, and relationships.
Okay, I think we can deal with probably one or two more. I see we're going quite over, but I think these are quite important questions to get through. And I think as long as clients stay online and ask and probably wait for the questions to be answered, that's probably a fair indication. So I think the next one, Thomas, is probably an unfair question for you because it deals with South African estate implications of ownership of this fund. But I think that's something we'll probably have to dig into from our side and give an answer on, because that's something we need to get a estate expert on. Typically, I know with things as far as residents or at least assets in Portugal is concerned, there's forced heirship rules. So again, that's something we can certainly from our side comment on. So we'll give answers on that one. I'll get the experts on our side to deal with that one properly. I think there were a couple of questions from an anonymous on the investment size, whether there's going to be a second fund. I don't think those we can deal with. I think those aren't that important for this particular one. But I think the extra cost, so that 11,000 euro in legal fees, will there be a breakdown in scope? I think we've done some estimations on those, given the work you guys have done, but there'll be a further breakdown. I mean, once they engage with the lawyers, they'll probably get a full breakdown on scope, I would imagine, no?
Correct. You'll get a full breakdown of that the moment you contact CCI.
Okay. Then please confirm the level of gearing on commercial properties, choosing secondary locations. Are you concerned that should the tenant fail, that you'll be left with a weak asset? I mean, you guys, it's probably just a lot of technical questions on the property side, and you could probably answer some of those, Malcolm.
So, Rich, I think let's try and answer it slightly more generically. There's obviously a process that one goes through in terms of appraising an opportunity, and in that you are looking at multiple things, including the strength of the covenant, the opportunity, the location of the asset, the opportunity to relet. In many situations, it is actually the strategy to get rid of a tenant and try and replace and grow income. I think the value of a property is driven by the cash flow that can be generated by that property. And what we will be looking to do is acquire property that is well located, and whether the current tenant continues to pay or somebody else comes in there with a given amount of capex and investment into the site, we will be able to generate income streams of a particular level, and hopefully increasing. It's the increasing level of income streams that drive the value of the investment. That's the whole process of commercial property investment. For those that want to dive into more detail on what our process would entail and how we would go through that process and how we would think about it, very happy to do that. I think it will take, it's a session in itself, Reggie.
Great. And then there are quite a couple of questions on liquidity. I think maybe just touch on the liquidity issue, that if clients want to exit, what is the liquidity on this? I think it's quite an important one for people to understand.
So, I mean, what you're making here is an investment for the time period. If an investor would like to exit along the way, so there was an earlier question that links through to that. If you have transferred the money into your bank account before the 31st of December, but for some reason the investment hasn't been made into the fund, remember that is your bank account. You can return the funds to yourself. So that was a link through to another question. If the investment in the fund hasn't been made, it's your money, you take your money back. So if 31st of December is important to you, you'll only make the investment into the fund at the time that you're comfortable that it's before the 31st of December and your application is going to be lodged. Once the money is invested in the fund, it is then a limited life investment vehicle. If you wanted to exit beforehand, there's no guarantee that you will be able to do so. There are rights within the fund for you to find somebody to take your shares. and that will be allowed in most scenarios if you want somebody to take over your position. Equally, if you speak to ourselves, we can try and find somebody to step in and take over that investment of yours, but it is not an open-ended fund against which you will ordinarily be able to redeem during the life of the fund.
And I think you can maybe, there was another question I saw here that links to that one. And I think it's more to do with the liquidation at the end. So how, once you've gone through the process, how the fund's liquidated at the end of the life of the fund.
So we're going to try, we will start, as we start realizing the investments, excess cash at that point. We won't pay a dividend out of income. It's not the intention. As incomes are earned from, for example, the commercial property investments in Portugal, that net yield will not be paid out to investors over the life of the investment. It will be rolled up. And when we enter the realization phase, as we realize investments and have excess cash available, we will periodically distribute that back to investors. And we will realize the assets in the way that maximizes value on each of those investments.
Great. And there's an interesting question here, and I think it is to do more with understanding the nature of the fund, because the person asks that if you're trying to raise 20 million euros, 8 million going to the UK with the balance going to Portugal. And I think you did answer it, but I think maybe just make it very clear for this specific question. It talks specifically about 34 people coming in, each contributing their 350 with that going to Portugal and the rest going to UK. I think it's not understanding the nature of the fund where everyone has a unit in the fund and that fund makes the investments. I think maybe just explain the clarity on that one for the specific question.
Okay, I think it's touching on the same point again, which is the split of the 60% Portugal, 40% UK has got nothing to do with the investor. The investors, that's the fund that's making that. The investors are 100% making an investment into Portugal. Your 350,000 goes into the fund, and you have a qualifying investment for the purposes of the application to the SEO. It's then the fund that must, in terms of the rules to be a qualifying investment fund, must deploy a minimum of 60% of that capital raised within Portugal, within Portuguese investments, in order to continue to be a qualifying investment fund. And of course, we will continue to manage the portfolio to ensure that that is the case. But it does allow some of the funds, a portion of the funds, up to a maximum of 40%, to be deployed outside of Portugal and still retain its status as a qualifying investment fund. You shouldn't look at your 350 as splitting it from the purposes of it being a qualifying investment fund.
I think that's one of the benefits for us of the Portuguese scheme, is exactly that, the flexibility in what falls under a qualifying investment fund and the ability to be able to invest part of it outside of Portugal.
Okay, I think, guys, we're quite over our time here. I don't know if you just want to have a look through the questions. There's one urgent one that you think we need to answer before logging off, but I think, as I mentioned a couple of times, we will definitely get all these questions answered. I've already got communications from my marketing team. They've got the list of Q&A that we'll send through to all the attendees. And yeah, I think on the back of that, unless there's anything urgent, Malcolm, Pierre, Nick, from your side, or Thomas, I think we can certainly close it off. It's been a very busy session. I think quite a couple of good questions, and certainly thank you for your input and time there. So I don't know if there's any closing remarks from your side.
No, I think I need to say thank you very much again for your time. Thank you, Reg, also for setting it up. And like we said in the beginning, we're definitely available to answer any questions. So please reach out and we'll get to answer it immediately. So thank you very much for everyone's time.
Yeah, thanks everyone. And with that, we'll hopefully hear more from you and be happy to answer questions. So thanks.
Yes. Thank you.
Thank you so much, everyone. Bye-bye.
Thank you, everyone.
Have a good day. Bye-bye.